And so Bitcoin sits at 40,200 after initially wicking down slightly below 40,000 as the market continues to reel in anticipation of the CPI reading we're going to get in a few hours. Yes, the market is super concerned about this whole economic environment we're in. I'm going to break down in this video what exactly is going on, because I was reading an interesting piece by David Roach, an investment strategist, who says we are not entering a recession, we are entering a war recession. So we're going to go into that. We're going to look at what that means and explain what that means for the wider macroeconomy. We're also then going to talk about what I think is going to happen in the CPI reading and what that means for crypto. So make sure you hit up the like button. Don't forget to subscribe. These videos are brought to you by my very own course member live stream, so consider checking out those. Ijaz.uk/member to get yourself set up. Links in the description. Now, the bit I wanted to talk about first and foremost is this idea that David Roach carefully and smartly coined as a war session. So your normal recession, first we have to go back and look, this is not going to be interesting for every crypto investor. If you're just looking for chart patterns and buy this 10x coin, this video isn't for you, so you might not want to watch to the end. But for the rest of you, a normal recession is when you have output falling, okay? So think of GDP. How much are you producing? Goods and services falls. And demand falls as well, okay? So as a result, inflation comes down. Prices come down, inflation comes down, and you let the market cool off. Now, that is a normal recession in a normal market environment. Now, the argument now is, given the variety and complexity of the backdrop we're in, are we going to walk into a normal recession? And this is a question I've received a lot, and obviously it's the talk of the town right now. Nobody really knows the answer. But what the indications are showing is that, you know, the concoction of different situations we find ourselves in do not lend itself to a normal recession. Output down, demand down, cool off the economy, get some lower inflation. Instead, what we are seeing is that obviously this environment we're in has come from an unprecedented pandemic with unprecedented money printing, right? We know that's what's happened. We then have this backdrop of a Russia-Ukraine war with never seen before financial sanctions, which are obviously going to have effect on commodity prices, on inflation, on supply. We also have the interest rate hikes. We've just had liftoff of interest rates. So again, that's an underlying challenge. And then on top of that, we've got this China supply chain COVID issue, right? So China's COVID cases are starting to tick back up. We've seen that they're mass rolling out localized lockdown, which has impacts on supply and port issues. And naturally, that is going to have an impact on prices. So we've got this weird mix of unusual events, right? This is not usual. This is not the normal way that a recession would play out. And to add to that, what you can see is that there is now a mismatch in the labor market. We're seeing the labor market really strong, which is not in line, it's not congruent with a normal recession. We're also seeing the price of commodities strong. So now you're in a situation where you could be entering, as David Roach has said, this war session. What he means by war session is output is down, but demand is still there. And that is what we're feeling in the economy. I can feel that anecdotally. Maybe you guys can, depending on where you are in the world. But I can speak for the kind of Western side of the world in that people have money. Average order values are still high. People are going out and spending. And that is why we're seeing some of those stay-at-home plays not doing so well, because everybody is out. Everybody is out trying to enjoy a little bit of sunshine if there is anywhere they are. Not much here in London, although we got a little bit today. And they're trying to go to restaurants, have experiences back again, right? We're seeing that demand there. But we're seeing that the inflation is being caused mainly by supply chain shocks. And we know interest rates can't address the supply chain side of things. It can just soften demand. Okay, so the argument then is that the Fed, the central bank, will have to choose between their target around inflation, keeping inflation at their target rate, and growth. So they've got this seesaw of balancing it. And if they get it wrong, they'll have to then taper in the interest rates. So let's say they start running and they start increasing interest rates as we're expecting, 0.25% each month, maybe a couple of 0.5% in there during this year. Now, if they notice that output is falling and they're seeing reduced performance and growth in the economy, at that point, they can then pull back interest rates to then help stimulate that back again. This is the game they're going to have to play. But the thing is, the market is assuming that that's going to happen quite quickly. I don't think so. I think we're going to see a lot of interest rate hikes, and I think the markets and the earnings from companies are going to continue to stay strong. And I think the markets are largely going to shrug this off over the medium to long term? Because, getting back to 2% interest rates is not the end of the world. It just feels like it because we've had such accommodative policies for so long. So the markets will get used to it. You do have a strong labor market. We saw that from the jobless figures. We're going to see the CPI reading coming in the next few hours, maybe even by the time this video is uploaded. And you will see that the consensus estimate is 8.4% year on year. Okay, that's the consensus estimate. Let's see if I can show you that here on the chart to put this into perspective for you. Now you can see that is sitting here. 7.9% was the last reading, and 8.4 would bring you somewhere up here for our March reading. So it just shows that this is getting largely out of control. I mean, if I switch this to the line chart, you can see there's no cooling off, right? So you'd want to see an inflection point. And by the way, this reading is expected to be the worst reading because this is when everything kicked off in terms of the sanctions, the wars. This is the March reading we're getting, guys. So this wouldn't even have taken into impact the interest rate change because that came into impact on the 16th of March. That would have a full month when we get our next 2 readings from now. So it's going to have a lag before that interest rate effect starts to be seen or not seen in the figures, in the CPI figures. And then and only then can Jerome Powell make the decision of, are these 0.25 rate % hikes doing enough or are they not doing enough? If he makes a knee-jerk reaction and decides to reduce interest rates at this next meeting on May the 4th by a double rate hike, and then this 0.25% rate hike he's done on the 16th of March starts to prove that it is having an impact, then he's going to be in trouble because he can't reverse then the 0.5, right? So he needs to be patient. He needs to let the market work. And I wouldn't be surprised if once he's done a couple of 0.25s, if we see a 0.5% interest rate hike at some point, maybe even a couple during the month. What would spook the market is a 0.75% rate hike. So if we head over to the Fed rate monitor tool, you will see that the market has all but priced in a double rate hike. So they're not bothered. They're almost saying to Jerome Powell, you go ahead, do your thing. 86% of the market has now priced in a double rate hike. Remember, this was just 80% a couple of days ago. We've been monitoring this regularly. And this extra 6% is correlated with the markets taking a dump, and obviously with Bitcoin falling, with the S&P falling, and with the NASDAQ falling. So the question now rises, what's happening? I wouldn't fall for now for this relief rally to the upside. The market is just holding in anticipation. It's just saying, look, we're going to hold this 40,000 level mark, and we're going to wait for this CPI reading. And if the CPI reading comes in super hot, over 8.4%, the markets are going to fall. The market's going to lose the bottom, and they're going to start falling to the downside. If we see us coming in at the estimate of 8.4, the market will do all right. It'll move a bit sideways. It'll be okay, maybe even slightly down. If we see it, if we see better than 8.4%, the market could use that as an excuse to start rallying or coming back into this wedge and trying to hold its level at the low 40s. That's what I'm expecting from the CPI reading. But more importantly, the single reading is not what's important. We need to see the readings over the next couple of months leading up to May the 4th and see, okay, Jerome Powell, what are you going to do? Are you going to do a double rate hike? Are you going to tighten too quickly with your balance sheet shrinkage, which we've spoken about in a lot of videos? And then we'll see how things play out. Now, as I've mentioned in my video, if you've not watched my video saying this is the moment I'm going to be buying the dip, I'm going to link that video up here because I already predicted and said to you guys that the Fed is going to crash this market. And it's a great time for us, if you have high conviction in your plays, to be buying on this pullback. So there you have it, guys. There is my thoughts on this war session and the uniqueness of this kind of environment we're in. I mean, everybody's saying, no, recession is here, recession is here. Even the yield curve has inverted, but then it's inverted, uninverted, inverted. It's a really unprecedented time, and a lot of people are struggling to decide which way the market is going. But more importantly, instead of trying to decide where the market is going, react to the information you have. Prepare for each meeting as and when it comes, and prepare your portfolio with your high conviction plays, and wait for those pullbacks to enter. As always, guys, don't forget to smash up the like buttons and subscribe. If you like my perspective, consider checking out those course member live streams. Links in the description, ijaz.uk/member. Get yourself set up, join our community, ask me questions, do some TA. We can do more macroeconomic stuff like this as well. We can do technical analysis on some of your favorite coins and a whole lot more. Thanks for watching, guys, and we'll see you in the next one.